Markets have avoided disaster and not fallen into daily downtrends, for now. The first taste of labor data, JOLTS, came in okay this morning, weak enough to help improve the odds of a Fed rate cut, but strong enough to avoid major recession concerns. We'll need the same thing from the ADP non-farm tomorrow morning and the government non-farm on Friday. If we hit expectations and don't see a massive miss, then the next key is looking for semiconductors to hold on to their critical daily support. Because if that breaks, regardless of labor, well, buckle up, it's going to get nasty. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight with a closer look at the SPY daily timescale, so we could talk about the trend first, and then we'll talk about the story on the hourly chart. For all intents and purposes, I would call the Tuesday gap down and subsequent intraday drawdown an equal low to the low that we had over here. Now, of course, if you want to split hairs with me, it's technically speaking a higher low, but I'm trying to give the bears a little bit of the benefit of the doubt. So the question that comes up is, can we reclassify the daily trend as down? And the answer to me is absolutely not. We are pulling back from the highest high in the trend count, which is the all-time high, and you can even see that, again, splitting hairs, it's a slightly higher low. We've rebounded off of that equal low into the midpoint of the range here. And as we'll see on the hourly chart, it's a pretty compelling story why there's no strong sellers here. We'll talk about those lower wicks in just a second. So the daily trend, at worst, could be considered neutral in this box. Fine, we have an equal low, and I will concede the point that yes, there's a possibility here for a lower high. It's not confirmed yet, but if we have a lower high and we trade back down to the equal low, again, I will concede the point that the odds would increase for some potential breakdown here to actually change the trend by bringing in a lower low. But the story we're about to go through on the hourly chart does not align with this by any stretch of the imagination. So this is a back pocket situation where if we find ourselves back at the equal low, 634, after a potential lower high here, then fine, we will change our tone when appropriate. But let's take a look at the hourly chart. I want to walk through this story with you of just how badly the sellers failed. So on the Tuesday gap down, obviously you can see the open is here. It's underneath the origin of the Jerome Powell rally from the Jackson Hole speech on Friday of now 2 weeks ago. It's also underneath what could have been considered the double bottom neckline from this move back here. So hypothetically, sellers on the open could have yielded a lower high in the most bearish position of the daily chart. That clearly didn't happen, and we actually rallied as the first impulse. But then from there, the market actually broke down, and the key component here is that the market made a new low of day on that Tuesday mid-morning session. So okay, new low of day, bears are kind of taking a little bit of a stand here. What's the only objective headed into the close of Tuesday for sellers if they're going to get follow through? The only objective is a lower high, likely underneath 638.15. Well, the ideal lower high would be underneath the morning low. The next ideal lower high would be underneath the opening print. Then we have the 638.15. And yet, where did we close on that Tuesday session? Right up at the high of day. So let's ask ourselves the question, do we have strong sellers expressing bearish sentiment on that Tuesday end of day rally? The answer is just absolutely not. Sellers failed in almost every degree of failure that you could imagine, not being able to produce that lower high. Okay, let's move along to today's Wednesday session. We technically open on a gap up. Gaps should fade, right? So, all right, maybe we should fade this to the downside. Okay, fine. Markets fade off, and then yet again, what do we see here? Perfect hold over the Tuesday high. End of day rally, you could call BS on that or not. It doesn't really matter what you think. The close, nonetheless, was back over not just this critical level from the gap close up towards that Friday low of last week, but more importantly, if I just zoom out a hair here, you'll be able to see that this level really is more representative of the overhead supply. This level is at 642.20. So you could hypothetically walk through the same situation and say, all right, on this end of day breakdown, yeah, the gap fill reversal is starting to step up. Buyers are starting to step up here, but all we need to see is a lower high underneath 642.20, and we have a bunch of trapped overhead supply. Longs will feel like this. Again, if we ask the question, did that actually take place? The answer is no. And in the after hours, we're still over that level as well, 643.50 by 54. So it's not to say that things can't change tomorrow morning on the ADP non-farm, but any opens over 643.15, the low of Friday, really just yield bullish consolidation here. And my preferable outcome would be for the market to attempt something along these lines if the ADP data comes in fine, really as a nothing burger, right? And that would just be hitting expectations, basically. I think the expectation is like 75K or something like that. So we'll see the data in just a second, but 645.25 is going to unlock upside because what that does is it starts to put all of the shorts off sides who got short into the close on Friday. Right? The whole tariff situation over the weekend, tariffs ruled illegal. Now we have it going to the Supreme Court. All of that has basically been unwound via this move higher, with sellers unable to produce any critical lower high. So if we think about the hourly trend here as a result of this, we have lows, we have higher lows, we have highs of Tuesday, and now we have highs of Wednesday. I don't know about you, but that's a higher high and a higher low, and thus the hourly trend is actually up. So as we move forward into the end of this week, the hourly trend will remain up as long as we hold up over Tuesday's high at 640.50. So let's just say that we open in range and consolidate here. I would still consider that bullish in the short term, trying to seek this higher low. Ultimately, this is a trade here, and this is continuation up through this thin structure from Friday of last week. The time where this becomes a little bit more concerning for that back pocket reversal we were just talking about on the daily time scale is if we do not hold onto that Tuesday high. If the market opens in range and then Brigade bolts underneath 640.50, I would think that there's a last-ditch effort at 638.15, but really this starts to look like the lower high we were just talking about on the daily chart from here to here. And if we break 638.15, then we're just dealing with bear flag consolidation, ultimately, on the hourly chart, something that looks like this. And then therefore, the equal low breakdown after a lower high, odds would increase there and the daily trend would change underneath 634. So the base case is that buyers are in control, but we can understand how it's possible on poor data release from ADP or even the full NFP on Friday from the government side of things. If we're underneath 640.50, that's where things start to get a little bit hairier, a little bit more detrimental to the bull case, and I would say much more detrimental should we find ourselves underneath 638.15. So those are the key levels, those are the areas that I would be paying attention to, and that's what the trend is currently suggesting to us. Buyers are in control, and sellers were completely unable to produce any lower highs underneath 642.20 on today's session, unable to produce any lower highs underneath 638.15 on the Tuesday session. Both of those things stack up as being more bullish than they are bearish. Let's come in here with a fib as well. Let's just take a little retracement from the high down to this low. Notice that we've closed right at the fib 61.8. The market had no problem staying supportive over the fib 38.2, so we cannot call this bear flag consolidation underneath the fib 38.2, so that's invalidated. And the more time, if we spend more time over the fib 61.8, the higher the likelihood of the 100% retracement. So if we're thinking about this in context of the levels, any consolidation here that then Brigade bolts over 645.25, again, that should improve the odds of the 100% retracement. And the base case on a daily chart anyways, if you're in a neutral balance range, potentially when you support the lows, you target the opposing end of the balance, which in this case is the highs. If we flip back into a daily uptrend via some sort of higher high over the all-time high, then we'll have more room for a higher low and we'll continue to watch the trend develop in the upward direction. Let's take a look at the intraday anchored view apps actually. Let's go back to the hourly chart here. And let's take a look at the intraday anchored view apps. The most important anchors that I care about are this breakdown low, the all-time high anchor, as well as the anchor from the Tuesday gap down. Now, what you'll notice here is all three of those white anchors were above them. Now, the Jackson Hole Jerome Powell speech is still technically resistant near today's high, and I will carry that forward. But I think what this generally suggests to me is that buyers will remain in control if we can support inside of this cluster. As long as we're over that 640.50, the anchored view app from the Tuesday open, I think we're doing all right. If we clear the stack and spend more time over the top of the stack once again, I don't see how you would reasonably, based on logic, trade anything other than some sort of continuation over 645.25, right? And if we drop the stack, I think just to concede the bear point as well, if we're doing this, then again, I would definitely put my bear hat back on. First step under 640.50, second step underneath 638.15. All right, that's what I've got for you on the Spiders Cash ETF. Let's take a look at the market internals for the NYSE side of things. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Ask yourself a simple question here on the breakdown intraday, right? Because the market did technically fade for a majority of the session in the downward direction today. Ask yourself the question, did stronger sellers step up at the exchange level? Do we have any evidence of new money sellers getting involved in the market? You could even ask the same thing of the Tuesday morning session when we broke down here. Well, if we look at volume flows this week, they're really not bad. Granted, they are out of the market, but they are not bad. They're not breaching negative 300 million. The advanced decline line tried to trend higher on that intraday Tuesday session, and today it was incredibly flat. If you look at the index score, which measures from the opening print, you can actually see that it's much more of a mixed bag. It's not downright bearish. If we look at the cumulative builds, they're not great. I will concede that they are bearish here, but remember, what's the key threshold? Plus or minus 5,000. What was the low of that Tuesday? It was hardly scratching at 2,000, not even halfway to a substantial read. This to me is more so digestion of the move rather than, once again, new money sellers not getting active at the exchange level. Let's take a look over at the market profile. What can we see here? The Tuesday session, and FYI, if you're not familiar with profile, check out the video tutorial in the top right-hand corner. Very simple, right? On Tuesday, value is actually elevated in the session itself. Point of control is slammed at the high. During today's session, value does continue to progress in the upward direction. The only caveats here is that value is unable to get overlapping yet to the Friday value from last week. If the market were to take that out, we know that there is thin structure above based on this single prints, these single prints in a period from Friday, and just generally thin volume commitment at price. The last thing I'll say about the volume profile and the market profile here is that we have a poor high or lack of material excess and a poor low or lack of material excess on the extremes of today's range. And therefore, the key question to sort of consider from a profile point of view is, does the market breach yesterday's high? And if it does, today's high, yesterday's high, tomorrow, then the key will become, do we spend more time above, or do we quickly wick through it, put in excess, and promptly come back down into range? If it's the latter, then we know that the market probably needs to digest further, and I'd look for chop through the value area. If the market accelerates through that and does not look back, we're talking about 5-minute pullbacks above, 2-minute pullbacks above, and continuation, then we want to go in the direction of that move and likely start seeking upside in the ES futures over the value area high from Friday, which is that squeeze level we were just talking about in the SPY cash as well. ES futures 64.75. If we go back on over to the Spiders cash, that's going to be the equivalent of up and over right here, 645.25. So everything sort of aligns here from a market profile point of view. Let's give this a reset and let's take a look at the NASDAQ side of the house. We know the NASDAQ is inherently weaker than the S&P. We know that that lower high was already on the table, and we know that the equal low has been produced as well via the gap down on Tuesday. I would echo a lot of the same sentiment where you can see that for the most part, buyers stepped up in that lower wick. There was no lower high really intraday underneath any key reference points. The market did not recapture this 566.50 spot. That's one nuance that headed into today's Wednesday session we were talking about was just, okay, the S&P on an equivalent basis actually closed above this key spot here, but I really think today's Wednesday close is just as telling for the NASDAQ, because what you'll see here is the low of Friday basically was the bottom end of this range, right? This was a multi-day range, 1, 2, 3 days before the breakout Thursday that failed. So the fact that the NASDAQ was able to recapture and close the daily bar over 569 is actually more compelling on the long side. Once again, if we go to that hourly chart just to tell ourselves the story or look at the story of price action, you can see no lower high here, closing at the high of day. There was also no undercut, no new low of day in the morning breakdown on the NASDAQ versus the S&P, which we just saw did. So then you can see here, again, sellers really should have looked for this into the close, but instead, they did not get that, obviously, and the close is back over that 569. So if the sellers were going to use all of this as overhead supply, you could think of it as a smaller version of what we talked about in the S&P, then ideally the close was underneath, and again, that's just not what we're dealing with. So as we walk forward into the remainder of this week, it probably looks something like 569 remaining a key level, Brigade bolts over 570.75, target the opening print from Friday of last week, just a hair north of 573.85, then really there's not much stopping this until the top end of this high, which is at 576.50. So the bull case is quite clear if we hold up over 569. If we fail 569, and again, this could be based on labor and the data coming out poorly tomorrow, it really becomes about 566. I would have to maintain neutral through here because we don't really have the strongest daily chart, noting that we already have the lower high in force. It's very possible that this could be yet again another lower high. So if we're trading here, I'd be very open-minded to any movement back down towards the equal lows, just like we talked about in the S&P, dramatically increasing the odds that we ultimately do poke through that 560.25. It's not a current threat based on what we can see from the lower wick here. If we just go back down to the hourly, we can see those buyers stepped up on the gap fill reversal in here. So buyers are doing their job. But if it were to break, again, if being the 566 spot, if we were to get in here, neutral, if we were to get here, bears in control, and we're concerned about the daily. If we're over 569, which is as of right now the base case, again, labor is subject to change this, but I would think given the failure of the sellers at the lows, given the failure of the sellers at the lows, this is kind of the primary outcome that I would be aiming for into the end of this week. The other opportunity would just be if the market rallies to here, pullbacks over the daily 20, so let's just pretend that's 20 continuing along, then seek this. Right, so 576.50 would be that next target overhead. Let's come in with the Fibonacci's on the NASDAQ. We can come in from the all-time high to this low, just to point out that this 569 is loosely associated with the Fib 38.2. The more time we spend above that, the less we can call this some sort of bear flag consolidation on the lows. I know, looks funky even with that anyways. Let's come in here from the local high to this low, and this reinforces the exact levels we just had anyways, right? Fib 38.2, negating the bear flag consolidation on the low. We're not here. We're in no man's land currently. We will become more bullish when and if we can Brigade bolt over the Fib 61.8, which is just the highs of this range anyhow at that 570.75. So all good in terms of confluence out of that. If we throw on our anchored VWAPs on the intraday, what do we see here? The entirety of the stack will be broken if we're over 570.75, and this is right here, the anchored VWAP from the Tuesday gap down right at 566. Everything makes sense from a Fibonacci and anchored VWAP perspective. Let's take a look at the market internals for the NASDAQ side. What we'll see over here is almost a rinse and repeat of the S&P. Very mild, not indicative of new money sellers. Same thing here on Tuesday via the gap down. You can see the advanced decline line a little bit weaker on the NASDAQ, which I think is reasonable considering the daily weakness anyways and that lower high that's already in place. A little bit weaker on the advanced decline line, and the same thing here on today's cumulative build. These are scratching at negative 5,000, but the read on the NASDAQ, this is the NASDAQ composite here, it does have to be slightly higher, right? Obviously the tick Q is not the NASDAQ 100, it can't print 1,000, but on the composite side of things, you're really looking at a 6,000 print. It's about 1,000 more. So technically speaking, got pretty close on Tuesday, did not get close, about halfway there on today's Wednesday session. Once again, just not really indicative of new money sellers stepping up. I think you would see a much more substantial volume outflow if that were to be the case. Let's get on over to the market profile for the NQ side of things. And what we'll see over here is a point of control and value area that is actually overlapping to that Friday session. So this is critical here. If I just do something like this, this is Friday's value. Notice that value actually was overlapping once again with Friday. So what that would tell me is that buyers are actually starting to get acceptance at these slightly higher prices rather than sellers saying, no, we're going to trap the overhead supply. We're going to make longs in here feel poorly, and we are going to stay below, right? So the more time we spend getting value to overlap or even get higher than the Friday value of last week, the better. On the bull side of the market. And once again, it becomes very clear that breaking over these highs really unlocks that thin structure retracement. There's virtually no volume at price through that breakdown on Friday. Okay, that was liquidation break in its utmost form. So you have a great excess high in C period, K period, excess low. Looks good here on the NQ profile. And once again, the key call out is just where value developed today. Much better than what we saw on the ES. Let's go back on over to the platform here. Let's finish up the indices with our good friend, the Rusty Russell, on the daily time scale first. What we'll notice over here is that the trend is much stronger than what we have in the S&P and the NASDAQ, noting that you have a clean series of lows, higher lows, and it's still very possible that daily higher lows can persist over 228.65. This is clearly the highest high in the trend count here. Mild pullback is okay. Something that looks like that would continue the trend. Not the greatest daily candle here. What you'll notice is actually the inverse of what we have on the S&P and the NASDAQ. A much larger upper wick showing us a rejection of this pretty key level here at 235.15. If we take a look at the, so again, daily trend is not in jeopardy of changing, but you can clearly see on the hourly how the market's a little reluctant to get back over that Jackson Hole speech high. And I think what the market's waiting for on small caps is more information on the labor side of the market. We know that this is more sensitive to the economic data anyhow. It's kind of like holding its breath right now. So one of the things I would just point out though on the hourly chart is the market technically took out on Tuesday via the gap down open and then the subsequent morning rollover. It took out the low of this pullback from here. Now I've updated the level to the true number at 232. But you can see if the market was going to roll over and just completely obliterate this thin structure off to the left, it had the opportunity to do so on a gap down, so bearish momentum, and it simply didn't. So I become very it's very hard for me to look at this chart and say, okay, bears are ready to rock and roll and this thing should go to zero, when that's not really the case. They didn't really step up here. Sellers definitely active at the Jackson Hole high, but if anything, this starts to look a little bit more like a double bottom opportunity. You could certainly argue for, head and shoulders as well, be my guest. But even if this does break the neckline, I would default back to the daily timescale and say, is it possible that a higher low could persist over the 228.65? And to me, the answer is yes. Daily 20 is there. Then the final thing I'll just sort of say about IWM is, on a relative basis, it's actually outperforming. Remember that, obviously the S&P, it opened on a gap down near the Jackson Hole opening print. Is the Russell anywhere close to this? The answer is no. Obviously, the NASDAQ made an equal low to these previous days back here. Is the Russell anywhere close to this daily 50? The answer is also no. So although the daily bar looks a little bit more compelling for the bears via that upper wick as a rejection, on a relative basis, it's actually doing just fine, consolidating and digesting the gains up here, looking for new information from the labor report, which is to be released, obviously, as we move through the remainder of this week. So to me, not all that bad here on the IWM. If we take out our Fibonacci's, this will actually be the only place we can do it from the low up to the high. Notice that the pullback is straight to the Fib 38.2, so from all views that I can see, this is really nothing more than just bull flag consolidation sitting on the highs in a daily uptrend, not violating key structure. Fib 61.8 is perfect confluence with the 228.65, which would just reinforce that, once again, that is ideally where that daily high or low would persist. So if labor data comes out poorly and the market freaks out, well, it's going to be sort of like bad news is actually good news because it increases the odds of a rate cut. But let's say it comes out so bad we're starting to price in a recession, right? If that's the case and small caps pull back to here, then I would say, well, number one, we're probably not pricing in a recession if small caps are supporting that daily high or low. But number two, the daily high or low is just going to keep the trend up, and it still becomes difficult for me to want to flip to a bear, right? And that's going to be a bullish tailwind for the S&P 500, not so much the NASDAQ. Now, if this is going to be a double bottom here, obviously your breakout point is the Jackson Hole high, 235.15, and that'll be it. Keep it simple here in the rusty rut. What happens with the neckline and what happens with the lows of this pullback at 232. That is it. Let's jump on into some anchored view apps just to see what's going on here. The cluster is converging on price right now, so I think that this is exactly what we want to see. We learn something when we get here out of the cluster, or we learn something when we get here out of the cluster. It's the same exact numbers that we had just referenced. Let's take a look at the Russell side of the market internals, then we'll jump into our sectors analysis and the whole 9 yards. Really no strong volume outflows as the market has pulled back or even just gone sideways here. Advanced decline line looks fine, trying to make an ascent. It's still technically under the zero line, we'll concede that. And this is probably a little bit more bearish on the cumulative builds out of the tick on the Russell side versus the other two indices, but really, again, not to a magnitude where I would say, oh my goodness, we're looking for an outright collapse. Really what you need to see over here is 2,000. That's the threshold on the Russell, and we just didn't really make it there. About 1,500 to the downside into the close both Tuesday and Wednesday. So with that, we'll finish up the Russell side with the market profile, see what we can glean here. Believe it or not, value is actually slightly higher, just by a slim margin. If that's value from Tuesday, here's value from today's Wednesday session. So there's a small uptick in value. What I find more compelling is just the fact that, of course, thinking back to this structure over here, if we take out today's high, there is nothing overhead from that Friday liquidation break. That would be the equivalent of getting over that 235, 135. I'm getting my Russell levels all mixed up now. 235, there it is, 235.15. If you get above that, I would think that you make an equal high in short order up at 237. There's really no deficiencies in terms of profile, maybe a little bit of a lack of material excess on the lows. The only final thing I'll call out on the Russell is a little bit of this 45-degree line. Shout out to Jim Dalton and Peter over at Shadow Trader for this, of course, but 45-degree line just tells us that sellers kind of painted themselves into a corner here, ultimately trying to short lower and lower and lower prices, technically higher and higher and higher as they make less and less and less progress, and therefore any sort of follow through over and out of today's range really should put the pressure on shorts or anyone who is trying to get active towards the lows of today's session in small caps. Just no follow through to the downside there. Let's get back on over to the platform, Thinkorswim, and let's take a look through our sectors and see what's going on. There's really two views that I want to share with you. The first one is the weekly performance. This does lean risk on, where you can see communications leading the pack, followed by tech and semiconductors. Then at the bottom end of the barrel, it's energy, real estate, materials, staples. All those things are sort of defensive or lightweight. The alternate view is looking at today's daily performance as we went for a gap fill reversal, trying to maintain some sort of bullish edge here. I'm not as thrilled with the daily performance. You can see that the bond market actually outperforms today, up about 74 basis points, followed by communications. That's decent, but here's where it falls apart. Staples up about 42 basis points. Discretionary on par with the S&P 500, and tech actually underperforming, only about 8 basis points versus the S&P's about 17. And then you can see as well, financials flat, and even semiconductors today taking a hit, down about 32 basis points. So really not the greatest posture as we come into tomorrow's open, given some of the daily performance issues there, but weekly, generally moving from the open on this advance off of the equal low, I would tend to side still with a slightly, not overwhelmingly, but slightly more risk-on view of the marketplace. Let's quickly rip through these sectors. Communications, obviously, with the Google move overnight, massive upside there, new all-time highs. As long as this gap remains unfilled, bulls on parade, in control, whatever you want to say. Gap fill reversal is still a clean shot at a daily high or low. If we look at the XLK, continuing to hold on to its neckline as long as we're over this 256.50, no big issues. I would say that the next best step would be a recovery over 263.50. If we can get that, some kind of move to be in here, that definitely makes me feel a little bit more confident that the lower high rejection is not going to improve the odds of that breakdown here. Moving into semiconductors, as noted in the intro, this is absolutely critical. If semiconductors cannot hold this zone down here at 283.20, doesn't matter what's going on with labor, there is a low volume void primarily in here based on the NVIDIA lockout rally that in my view would likely be the target, right? I'm not, let's just do this real quick. Let's go weekly volume profile and let's just close this up. We don't need a full year. Excuse me, let's try about a 9-month rotation. There we go. So the point being is this shelf, right? If we break this neckline, there is nothing in here, right? I shouldn't say nothing, but you get the idea. There's not a lot of volume commitment at price, and it would seem more reasonable to me that cracking the prior all-time high at least doubles the range, right? If you think of this as a range, this would sort of be the measured move of the head and shoulders. It's right on spot. Right? It's perfect. That's 264.75. So I don't bring this up because I want semiconductors to crash and burn and go to zero, or in this case, 264.75. I just bring it up because I think it's a valid threat where if semis do break down here and the semiconductor world sort of cools off and the AI mania takes a chill pill for a minute, then, like a pullback for that would not be unreasonable. I think the big thing to remember here is if you go to the weekly chart, right, this is like well within the confines of what's possible in the market. Is this the end of the world from the weekly? Absolutely not. I mean, we've been straight up off the April tariff lows, finally starting to cool off. I'm sure some folks would call this the classic Wyckoff distribution. Call it what you will. It just has to be a critical watch. If you're not watching semis at the neckline, then I don't know what you're doing here. So one thing I will say, and we've sort of joked around on X about this a little bit, sometimes when the pattern is this obvious, right, it doesn't actually happen. And if that's going to be the case, then fine. We're not actually changing our tone to bearish. We're not actively shorting this unless we're underneath at bare minimum, no pun intended, 283.20. Okay? If the market rallies, excuse me, there we go. If the market rallies over 293.15, hallelujah, saving grace, no problem, all set. I would sort of put the bear thesis away and start looking for trend continuation, or even if you just call it a range trade, look for the top end of the range to come into view. When and if we get there and it remains a range, of course, we'll change our tone to being a little bit more bearish, maybe a pullback from the equal high, right? Unless there's some new catalyst, AI is booming again, we'll see. But that's the SMH conversation. Let's jump into the bond market. We could sort of get rid of this volume profile thing now. Just put this back on is fine. There's our daily. We want the daily 20 as well. Did we click the wrong one? We might have. There we go. So inside of this range, not much to talk about. I think that the labor report will really be the next catalyst for this to do something. It's got to get over 88.25 or under 85. Thought there might have been some put selling opportunity in here. Unfortunately today, just right back to the midpoint of the range. Let's move along to discretionary. Chart looks fine. A little bit of that concerning upper wick thanks to Tesla, of course. As long as it's over 227, it's very difficult for me to maintain a bearish stance here. Still think that you have lows, possibility for higher lows anywhere over that number, which was the previous breakout point from here. Obviously, the best outcome would be over 232 into the end of this week. If we look at healthcare, a little bit of a consolidation trying to build out bull flag. Still reluctant to call it anything other than a range, but the fact that this gap is not closing is at least a little compelling on the long side, and you'll see this expressed as one of the trade ideas in the end of the video as a additional outside of the core list. If we look at energy, a little bit of a look above and fail here on the range. If this lower highs and comes back into range, we would just think that energy is not really producing a major upside pressure on inflation. If we look at real estate, stuck sideways in the range, not much to discuss there. Materials, same concept, midpoint of the range, still bullish, like we'll call out when something's bearish. Staples, got to watch 80 as long as we're above it, midpoint, neutral, bullish technically. If we break down, it's still technically a D for defensive sector, so not the end of the world even if it does. Let's move along to industrials. Not much to say over here. Would have been better to get consolidation over here and avoid this breakdown on Tuesday, but it is what it is. Unless this is actually going to trigger the double top, aka under the neckline, really can't flip tone to being bearish quite yet. Financials look fantastic. I actually think that there is a reason to watch JP Morgan tomorrow. It's, very rarely do we trade that, but it does just exist on the list to keep an eye on financials. Look at this inside hammer after the previous day's hammer, and notice also it's holding over the previous areas of resistance. So if we could break up and over, about 53.60 is looking for upside back to the all-time high in the financial sector. If we look at utilities, and remember, financials are the second heaviest weight sector in the S&P 500. If we look at utilities, this prior resistance now trying to act as support. It's a lightweight and defensive sector. Not the end of the world if it breaks, but if it does support, it's just another sort of chip in the hat, or what would you say? Feather in the cap for the bulls, sort of signaling that rotation thesis remains alive and well for the S&P 500. Let's jump into our ratio grids and see what we can see from this perspective. Do we have any overwhelming evidence of risk off taking shape here? And if you're not familiar with ratios, check out the video tutorial in the top right hand corner. The answer to me is no. The risk off look would be if these uptrends dramatically start really getting going in the upward direction, and that's not what we see in these lower three. If we look at the top four, which are the heavyweight risk on sectors, this is still not great, but this is looking better. This is looking great. This is also looking pretty decent here on the XLY. So it's very difficult for me to say that we have a risk off environment, which is what we noted through the posture as well, evaluating the actual percent performance. If we look at some of the specialized ratios, not risk off yet, still neutral, not risk off yet, still neutral, not risk off yet, still neutral. This is just leaning bullish. This leans still neutral in here, not making a new pivot low, as does the small cap side of growth versus value. So again, not enough evidence here to flip to an overwhelming risk off stance. I do think that risk on is obviously cooling off. It would be irresponsible to not acknowledge that, but it's definitely not like duck and cover and prepare for bear market, like you've never seen before. Gold obviously outperforming here with the whole tariff situation and the uncertainty there. I do think that gold could be subject to a pullback just based on a ratio we were talking about with the group. If we take a look at Bitcoin in full screen mode, I do want to go to the daily chart. There's a little bit of this breakdown tension happening here, right? We know the double top neckline has been broken. We know this is a lower high underneath. If this is actually going to invert as an inverted head and shoulders, and second component, we can get a higher low above the level at 113,850, I would reconsider putting a Bitcoin swing trade on if we could also pair that with, it doesn't look like it's going to happen yet because of gold's relative performance, but if we could pair this with a Sailor Shift tool also moving back to green, that would become really compelling as well. We're not there yet, but it's something I have in the back of my mind. The alternative here is using Ethereum, which has great relative strength. Ignore the study down below, that was not built for this, but if we break this sort of trend line in here, notice the hold, no breakdown of the double top. This looks a little bit better, and we know there's a little bit more retail enthusiasm, so to speak, surrounding Tom Lee's BMNR and the new Ethereum treasury that they have in that company. So worth paying attention to these two. Let's jump into, this was the B set, by the way. I do just want to point out as well that although the TLT outperformed on the individual session today over here, it did not really do anything to change its flight to safety style ratio over here. We're not dealing with a risk off environment based on that. Let's take a look at the dollar and interest rates, kind of unchanged in this little range that we've been dealing with recently. Again, until we get a big break and some sort of major surprise out of labor or inflation, I don't think these things are moving all that much. Let's jump into the inverted ZT as this continues to just drift slightly lower. Of course, that would imply that the odds of a Fed rate cut are continuing to move in the upward direction, which they absolutely are. We went from about 91% earlier on in the week, which was just the other day because it's been only 2 days so far, but 96.6% as of right now. If we take a look through some of the fundamental data that we've received thus far, the JOLTS job opening openings comes in right on par with about 7XX million jobs being open. It's not such a deterioration where, oh my goodness, we should, get prepared for a recession. We're not dealing with that. What I will say is that the ISM manufacturing PMI, some of the anecdotal evidence, if you go and, if you're a nerd like me and you actually read the report and you don't just look at the number, you'll read anecdotally from different manufacturers. Go look at the comment section, basically. People are not seeing good things, basically. Prices are up. Output is technically not up in the sense of new orders and such, but rather just stockpiling inventory based on tariff uncertainty. Again, go read these words directly from the report. I would encourage you to do so. Generally speaking, I think that means two things. Number one, in the short term, manufacturers will try to raise prices as much as they can before the consumer ultimately taps out, and then it becomes a race to the bottom end of the barrel. If and when people stop buying, then it becomes all about, okay, can we reduce our prices, and where's that floor, and ultimately that's deflationary, but only in the long run, when and if that takes place. The next big one to come out is going to be the ADP, which we talked about already in today's episode. We're looking for about 73. It looks like I was off by 2,000. I think I said 75,000 earlier on, but 73,000, that's certainly down from previous, but not to a magnitude where, oh my God, we need to start ducking and covering. When this goes negative and sustains negative, that is where it's like, oh my God, this is not good. We are not there yet. Actually, as a matter of fact, last report, we beat on the upside. So we'll see if that does give a positive surprise. That would, of course, keep the lid on the recession narrative, but maybe put a little damper on the Fed watch. The next key report is going to be the ISM Services PMI, and what I really care about there is prices paid, because this has a much better correlation rather than the manufacturing prices with actual inflation. So watching that very closely. That's tomorrow morning at 10 o'clock Eastern time. And then, of course, on Friday, the full Monty labor report. What we want to see is the non-farm payroll, the government print, come in at expectations with little to no revisions from prior. Does that happen? Likely not, given the quality of data we've been working with over the last couple of months. Let's move along to the earnings calendar here. Not much to talk about. ZS hardly changed. CRM is slightly lower, and the big full, sort of major event for the week, at least earnings related, is going to be Broadcom. That's AVGO after the close on Thursday. That has the power to move the semiconductor sector as a whole. So very, very interested in AVGO Thursday. If you're not watching that, if you're not at least aware of that, then what are you doing? Certainly take 1-800-Flowers off your list. I don't know if that's just a joke. I don't know what this is all about. Why that's always at the top of whatever day it reports is beyond me. Maybe an inside joke over at Earnings Whispers, in which case, great. I actually enjoy that. We have plenty of inside jokes up here in the office. Let's continue along and let's take a look at what's going on with our bond relationships. All I would point out here, took a little second to load, is that this broke out and now it's coming back down below. I would pay very close attention to this. If this breaks out and continues, it's the bond market telling us that, okay, buckle up, we're probably going to prepare for some kind of inflation, right? Let's move along to the credit spreads. Starting to realign and reconverge. Remember that this typically, we give it the benefit of the doubt and look for it to reconverge with the lower credit spread here, which would be bullish for risk appetite in equities. If that does not happen, then what we need to see, or the way that I would sort of invalidate this, is if this goes on to produce in the SHY-HYG version, if that goes on to make a new high, then I would say, okay, game over, definitely be paying a little bit more attention to volatility over in equities, aka risk appetite for equities. Let's jump into junk in isolation. Not bad, it's kind of on par with what the SPX did if you just jump this in here. A little bit of a rally off the lows, a little bit of a rally off the lows. Not all that bad. Not something that we should write home about in terms of divergence. Total breadth, a small deceleration here, but still over the 50% mark. Notice that new highs versus lows is also over the zero line. So although Google was the primary driver for the market upside today, based on the antitrust stuff, it's not like breadth was collapsing and, oh my God, everything else was selling off hard. You could see this as well in the RSP, where you still technically have kind of a hold right around in this area. Worst case scenario, you could use these lows as well and just say, okay, there's your range. As long as we're in that, we're doing kind of all right, noting that the weighted S&P pulled back anyways to that same low. If I just hover my cursor here, let me zoom in a little bit further. This low in here is the same low as this low over here, right? So actually doing okay here on the RSP. Where we're doing a little bit worse is the NASDAQ equal weight. What you'll notice here is just a big balance range. So it technically still has a big offering of a lower high, and any threats underneath that become a little bit more compelling for the short side Once again, it's really just due to Google and the subsequent Apple result from today's session that's producing the upside on the weighted side of the indexes, whereas the equal weights, not as much participation. If we take a look over at volatility, excuse me, volatility coming in a little bit after a little spike. That's pretty typical of volatility. I wouldn't expect anything different. Same thing here in the VVIX, back under 103 is actually quite comfortable. Then if we jump into vol futures, notice that we're still in a deep contango across the different time frames, the different series. Same thing here, 9 versus 30-day VIX, and the 1-day VIX is completely comfortable inside of that 1275 by 745 spot on the daily. Let's jump into our core list of companies. I'll give this a little reset here and kick things off with NVIDIA. NVIDIA really leaves a lot to be desired. You definitely have this as a daily balance range. You're just noodling around near these lows. You have an inside doji today. Daily 50 is right in here. I don't love this as an idea. It's not going to be a top priority for me to watch as a trade tomorrow. I think if you're over 170.60, maybe there's some kind of odds for this over sort of what could be considered double bottom neckline. Again, it doesn't strike me as a top priority. It's definitely very sloppy here in terms of its intraday suggestion of what's actually going on, right? Just an inside candle. So inside bar break, maybe, but not a top priority. Let's jump into Microsoft. This is probably on ice as well, noting that we had this big failure from sellers to go lower on Tuesday's gap down. But notice today we actually failed to go higher via the upper wick of the Wednesday bar. In a picture perfect world, buyers would have gotten here, and then there's a nice trade available over something like 511.25, see it on the hourly. Over this for thin structure up towards 518.50. It seems like there's lower odds of that taking place as of right now. Not going to write it off in its entirety, but Microsoft, to me, has to do something like that if it's going to be an active trade. If it's going to be a short, it has to be under 498. Let's jump into Apple. Great trades today on Apple. Sympathy to the Google move and the antitrust ruling, of course, and thus, the direct cash flow over for, using, Chrome as the default browser or whatnot on iPhones. Regardless, nice higher low hold over the top end of the daily bull flag. Great breakout, great hold. I think everything looks fine here. If we look at the hourly chart, nice move into the end of day, pushing over the morning high and closing there. Any pullbacks that support 236 continue in the upward direction. Any Brigade bolts out of range continue in the upward direction, 242.50. If this is a daily bull flag breakout, let's just take a measured move out here for a second. Let's come in from the gap up. Let's do this just to sort of really put the brakes on it a little bit. We don't want to be overly aggressive. Come on, get a click. There we go. If we're looking for a 100% extension, I don't want to call for an all-time high in the blink of an eye, but 253, if that daily bull flag is going to get the measured move, pretty interesting there. At first target, 61.8 seems reasonable at that 242.50 spot. So Apple looks great. If it is going to be a short, I would not short it anywhere in here. I would need to see it fail back into the bull flag range, which is underneath 234.25 for the gap close at 230.85. That would seemingly be a lower probability or a lower, it wouldn't be my top priority headed into tomorrow. Let's jump into Nancy and see what Amazon has for us. Daily chart is abysmal here. I think if you're trying to trade Amazon in this daily chop and slop, you don't have a daily trend. You've got lows, equal lows, kind of higher-ish low, high, equal high. This is the midpoint. There was a little gap in here. You've got your moving average cluster. Just no reason to be trading Amazon in the midpoint of that range there. I think it needs something new over this or under this, and then we'll start to have some better trades develop on Amazon. Google, awesome sort of just continuation play of the big gap up on the antitrust ruling. So Google does not have to sell Chrome, of course, and it's just going to be a simple watch, high and low of day. There's really not much structure on the intraday that we want to key in other than that. So this blue sky territories, this slow drift of the gap close. I would even be skeptical of trying to short that, just noting the massive relative strength that Google has had prior to the antitrust ruling, right? If you look at the broad market relative to this grind to the upside out of Google, Google is actually stronger through a majority of this push here. So in my view, don't want to be trying to be aggressive through the gap. If it's a no-brainer, if there's an easy way to manage risk, then maybe, but it's not my top priority. Let's continue along to, going with the gap would be the top priority there. Metaverse, what's going on with Metaverse? I think that it leaves a little bit to be desired. The sellers can just not get anything going into the gap range. Like first attempted break into the gap range failed, popped back out. Second attempt on the gap down Tuesday failed, popped right back out. I think that the next idea here needs to be a short on a lower high underneath 745.50 previous highs. So let this rally continue a little bit. Daily inverted hammer, yes, but really if you just look at the hourly chart, little wedge here, a rally rejection there makes a little bit more sense. That way you can at least posture for risk reward like this, and then balloon runners towards the remainder of what the gap is. If we're just in here, I mean, how many times have we seen Meta try to push into the gap range and just fail? Doesn't really seem like a top, I know I keep overusing this, but it's not a top priority. Being short dead on the lows, I would prefer to get short on a lower high, right? You saw that worked here more impressively for the short. It probably works better here as well if it is going to continue in the downward direction. Very difficult to want a long metaverse right now being underneath 745.50. Next up, Tesla. Another junky daily chart. Very similar to Amazon, where you could just look at this and scratch your head and say, all right, what's the trend here? You've got all these lines on the chart, but like, what is it actually trying to do? The only thing I could maybe justify is like, all right, in the short term, perhaps there's a bit of an uptrend happening here. Junky action near the moving averages. It's been up, it's been down, it's been all over the place. What a wacky day today. Big morning washout, only to rally it all back and give it all back into the settle. I mean, just, it's all over the place. So in terms of a clean, clear setup that it's offering at a key level, I'm not seeing it. I would think that if we rally, maybe this is still available to the upside over today's highs, 341.75, 347.25 target. If we just are chopping around in here, I just don't see it. I don't see it. Goes straight up, goes straight down, goes straight up and fails. It's tough. It's a tough one. So on Tesla, you either need to be quick draw McGraw and on Johnny on the spot with the exact trade, not overstaying your welcome, ready to trigger a stop, or you just avoid it. Wait for a cleaner setup to unfold. And for me, it's probably a combination of the two, but probably more so the latter. Let's take a look at JP Morgan, which is actually going to be a decent watch for tomorrow. Hammer candle here, all-time high above 301.25. If you look at the hourly chart, right, this would sort of be the triggering of a double bottom neckline. Brigade bolts over the level, looking for blue sky territory. So JP Morgan, very rare that we trade it, but love the holds over the top end of the range here. Financials are a strong sector right now. If this breaks for upside, I'm interested. If we look at Palantir, another one kind of disappointing, very similar to Tesla. With the group, we were able to close out of the 150 put that we sold on this aggressive day here. We captured more than 80% of the premium. That was quite cool. But it was, I think, more importantly, if anyone's ever been a premium seller, you know this lesson. But if you don't know this lesson, right, you don't want to wait around for the final pennies of your premium to expire. You don't want to wait around for the last 10 cents of your premium to expire, because in here, if you could take this off for like 30 cents, 40 cents is where we ended up taking them off for, look at this end of day move. Now you're stuck waiting again. And if we gap down lower tomorrow, 150 is back in the money. No good. So anyhow, Palantir all over the place. Crazy morning washout, immediately back to the top of the range. No higher low hold over 158.15, back to the lows. It's just a chart that needs some kind of movement out of this for the next big main idea to unfold. That's 162.25, 152.50. That's it. That's it. Until we break out of this range, not much to talk about. I was really interested in the possible Brigade bolt over 158.15 because of how equal these highs were, but the way that this unfolded, nearly impossible to take advantage of, and no higher low on the pullback over here about midday. So Palantir on ice for now, needs to break the range. Let's jump on into Broadcom earnings this week. So any analysis I do on this will be invalidated basically, but generally would lean a little bit more bullish ahead of earnings, holding 299.50, noting that that is over these equal highs from here, as well as the daily 20. If we rotate into the equal high there, that of course puts upward pressure on the SMH as we come into tomorrow's session. That could be useful information if we're trying to find trades on NVIDIA, but more importantly, AMD. If we look at AMD, right, we would want to avoid shorts on AMD because this looks like a short setup as of right now. Bear flag breakdown, lower high, inverted hammer, right? We could look for shorts underneath this zone, but if Broadcom is ripping in the upward direction, if the SMH is really reluctant to go lower, I might not be as interested in this AMD short. If we take a look at the hourly time scale, you can kind of see how buyers had an attempt into the close to get over that 163.65. At the index level, we saw the end of day rallies, really impressive on the S&P and the NASDAQ, not so much in the AMD, in AMD alone. Right? So no move to hold over the morning high and instead closing weak in the range. I would think that the setup is short underneath 159.25, but once again, please be a little bit more respectful of that Broadcom and what it does ahead of earnings. Watch your SMH as a ETF overall if you're trading AMD on the short side here. So 159.25 is the level. If we break underneath, right, next step is underneath the low of Tuesday, and the door is wide open for the gap close down here. Just like the SMH, we can actually go to the daily chart here and just throw this on real quick. We'll just show you the volume profile to indicate that there's really nothing in here, right? I shouldn't say like nothing. Again, we use the same hyperbole over in the SMH, but there's very low volume commitment at these prices, even from all the way back here, right? Very gappy action in the past, very gappy action in the near-term past. So if the price of AMD is to get underneath that 156.50, there's not much supporting markets to at least that gap close, which is the trade that we want to have some degree of exposure to if ultimately this is going to be your double top. Here's your lower high already in force, and a neckline break is underneath that level. So AMD is worth game planning for, and that's your downside sort of idea. Let's jump into Robinhood, and let's take a look at the other study set here. Let's go to the daily 2050. There we go. What are we looking at for Robinhood? So bears are in control, and this as well, like similar to AMD. Here's your double top. Here's maybe your lower high. It's just all about this spot right in here around 97.75. Does it or does it not break? It's been very reluctant to do so recently. You could see on the gap down Tuesday, very reluctant to do anything. This morning, I think it was still solid that the overhead supply weighed on price to the downside here, but there's really nothing happening inside of this 2-day range. So until we can do something on Robinhood over 102.75 or under 97.75, I would let this be. I would think of it as bearish consolidation, undoubtedly, via these lower highs, but you action on that when and if we actually take out the low there at 97.75. Next up, I've got 4 ideas for you. One of them is a rinse and repeat. Let's go MDB, which is Mongo database, still on the docket given the consolidation here. Notice that the lower wick looks underneath the 2 equal lows, closes back inside of the range. If we take out the equal highs, MDB is a high flyer on earnings. Momentum might continue to close the gap overhead. You can see I've got my alert set. I'm watching that very closely. Simple bull flag, inside bar breakout setup. Let's go to UNH. Up next, let's completely pull a 180 and go over to healthcare. This little consolidation range here is getting interesting, noting what's happening with the XLV. Remember, XLV is not closing the gap below. It's pressuring the top end of its range. If UNH wants to give a little one of these over this 313.65, I think you have all of the Warren Buffett chasers say, oh, look at this, let's add to the positions, right? So I think that catalyst alone, or that sort of herd mentality, might be enough to get one quick pop out of it, and then we will reevaluate. I certainly don't think that it's going to be any sustained, like, you break the top of this range and the next, you blink your eyes and you're at 500. It's going to be much longer and harder road than that, and we'll see if retail can stick in there long enough to see it happen. Let's get back on over to tech. Let's go over to CoreWeave. CoreWeave's an interesting one based on the possibility of a breakdown underneath 86.40. If you take a look at the hourly chart here, there's really not much underneath this low. So notice the low. You take that out, 86.40s, lower high underneath. Look left. Oops, we want to not edit. Whoa. Let's auto zoom, please. Looking left here, there's really not much, right? This is sort of like grind, that big euphoric run in the upward direction. There's really thin structure under 76.90 to 67.75, but something like under that 86.40. Let's hover the cursor at 86.40. It's going to be right around in here. Under this, you're talking about that. Under where? Oh, there we go. He said it. So that's CoreWeave, okay? H pattern on the daily. Let's just go to the daily here. H pattern on the daily, rejection of the 20 SMA, equal low breakdown. I think you have some thin structure to get into. That's the premise of the idea. Let's finish it up going back over to healthcare. So we went tech, and healthcare. HIMS, we need the S. There it is. HIMS. It's a little bit of a sleeper. I gotta say that I've been against HIMS for a little while now. It doesn't really fit into my long-term portfolio based on its theme. Doesn't really fit based on the price action either, but as a trade, I do find this somewhat interesting as a chart. Notice the equal low double bottom off the daily 200, and if we can take out today's high, aka the neckline of the double bottom, it's also a break through the daily 20. If we look left, there's not much structure here, and instead you're targeting the major inflection point at 51.70. So if HIMS can do something that looks like that, maybe there's a little bit of a trade opportunity on this little there's too many jokes to make about it, but I don't know if we want to associate ourselves with those style of jokes. Does the Trade Brigade brand do that? I don't know. Probably not. So 51.70 is going to be the target there. Should we get the break up and out of this little range, call it a double bottom. Love the hold of the daily 200. Looks tradable, but I probably would respect that 51.70 as a major hurdle that there's going to be some battle at. This is probably not an easy spot for him to just go off to the moon and hit 100 like, yeah, we won't associate with that. Insert whatever joke you'd like there. Off to the moon at 100. All right, that's going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, feel free to let me know down below in the comments section or by giving the video a very simple thumbs up. We might not have coffee and donuts for tomorrow's session up in the office for the pre-market prep. Remember, that's every morning, live, 8 o'clock Eastern Time, here on the channel, free, open to the public. Come hang out with us here on the channel. No coffee and donuts tomorrow, but I can promise you coffee, donuts, croissants, omelets, whatever you want, Friday morning for the Full Monty Labor Report. We will be watching that all together at 8:30 when it's released. We will start the live stream at 8 o'clock as we do every single morning. With that said, enjoy your first trading week of the month of September. Hopefully it's been a good one for you. Check out the links listed down below if you're interested in additional resources. I hope you have a green trading week, and I will see you in the next one.